Have you thought about growing your wealth but don't know how to start? Talk to Invest by Metricon. They make property investing easy. So for all your tomorrows, build your financial future today. Invest by Metricon. Build wealth. Build today.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host, Smart Property Investment Show, executive editor, real estate, Momentum Media. Hope you're well. Hope you're enjoying COVID life. Hashtag. We're recording out of Sydney, New South Wales. It's funny as you navigate these COVID restrictions and watching all the commentary coming out of all the political leaders, how things change so quickly. Probably 2 weeks ago, I was sitting there going, wow, I don't see us getting out of this before Christmas. And this last week or so, and the speed of vaccination rates would indicate that we're at least hit 70% single jab. We should be 70% here in New South Wales, double jab within the month. And now they're talking about there's a date set in October for Freedom Day for those which are double vaccinated. So that bows itself to people emerging from their homes, locked up in their pajamas into late spring and into summer. I think it is going to definitely be the roaring 20s in Sydney, no doubt, when they let us out. It's good for events. We can go back to pubs, but importantly for property investors and those in the business of real estate, get into open homes, allowed to visit them. There's not a lot of stock on market at the moment. I think everyone's sitting around biding their time, waiting to see what happens. But when that starter pistol is pulled and it's going to be the races on. So I'm going to look forward to navigating that over this coming period of time. Fortunately, I can get on the phone or get onto the Zoom people in property right across Australia to give some sense of what's going on. And we can either agree or disagree today. I don't know. Let's see how we go. Chris Gray, your Empire, joining me after a hiatus for about 18 months. How are you, Chris? You well?
Mate, I'm very good. I think the last time I saw you, I turned up on my 1912 Model T.
You did, and now you tell me, just before we come on air, that you've replaced that for a unicycle. What's going on?
I have. Well, I actually crashed the Model T a few months ago. I had the choice between rear-ending a truck, a car, or mounting the pavement and going for a lamppost, which I did. Wrote it off, so they're completely rebuilding it. And so I thought my goal for COVID, rather than sit around doing nothing, I've had a unicycle in the garage for 10 years. It's been my boyhood dream. And so I've got to ride my unicycle unaided while drinking a beer at the same time. And I'm about 80% there. I've just got to do the beer drinking part now.
And is that for a period of like a distance? You're going to do the whole length of Bondi Broad Walk and back with a beer and finish it?
I think the goal was to ride a unicycle while I'm drinking a beer. So even if it lasts for 1 second, and someone even said you could just hold your unicycle and drink a beer and you're 75% there anyway. So I'm very good at adapting the rules depending on how far I get.
So maybe with a couple of beers in you, you'd be able to ride that unicycle better. Who knows?
That's probably a good thing, as long as it's downhill from the pub.
Helps with the equilibrium, but we might be allowed, or I think we'll be allowed back into pubs come late October. We'll see how we go with that. But just this Model T thing, I remember seeing the car and a Model T, channel your thoughts of, I guess, chitty chitty bang bang type of thing. It's probably not doing a huge justice, but you wrote it off, so they're rebuilding the whole thing. I guess you can't replace it, right? You've got to take it to a shop and they've got to bend all the metal back into space?
Well, I've got this knack of always being able to spin things. So I bought the car for about $32,000. It was insured for $58,000. I didn't hit it that hard. It was maybe 10 or 20 Ks. But basically, the three pedals are completely different. Look it up on YouTube if you're interested. It's the hardest car in the world to drive. But I basically couldn't get it out of high gear. And basically the brakes don't work if it's in gear. So you're driving a car that's over 100 years old and you can't stop it. So anyway, I was very thankful to Shannon's. They paid to write off the car. So I can now rebuild it. They give me the car. And so I found an old boy down in Melbourne that's going to put it all back together. So I'm almost going to get a brand spanking new 110-year-old car that will be so much easier to drive. Suddenly I've got all the old parts replaced. And so I think my wife and my accountant said it's a sign from God. You've almost died 3 times. You should give it up. And I'm saying, no, this is a sign from God that I rebuild it and I get a brand new one and I can drive it for the rest of my life.
What's the other 2 times? The other 2 times you've nearly died?
So I had another time that I did a 360 in the middle of a crossroads in Pyrmont, in the middle of the rain in front of a cop car. And I turned around to them and I said, look, I think my steering has gone. And they kind of nodded and said, yeah, we think it has. So we pushed it up the bike lane. And I did another time. I was doing about 60 Ks an hour and my left rear wheel overtook me and pushed me in the middle of oncoming traffic. So that was a close call as well. So I think I've banned the kids from being in there because there's no seat belts, there's no nothing in there. So it's not the safest car. So if anyone sees me on the streets, take a wide berth.
There you go. Maybe a metaphor for real estate in Australia, mate. The wheel's sort of going faster than the car itself. Do you like how I did that? What are you seeing at the moment? You still investing, Chris?
Oh, look, this is my 30-year payday, as I like to call it. So I've been investing since 21, now 30. I think my portfolio is about 20 million at the moment. And as most people know, the market's moved at about 10 or 20% or 10% probably the last 6 months and hopefully another 10%. So this is where I'm potentially making kind of $2 to $4 million. So one thing I've learned in the last 5 or 10 years from a property investing perspective is at some point you've got to say there's a limit, because whether you've got 10 million, 20, 30, 40 or 50, after a while, your life doesn't really change. And so it's not worth killing yourself, being at 80% finance to have a bigger and bigger portfolio, because suddenly if something changes at 20 million or at 30 million, it's a lot harder to find the extra repayments than it is if you've only got $1 million loan. And so what I learned early on was to be grateful for what I've got. 20 million was more than enough for me. I've still got debt on that. I'm about 50% geared. And so really my goal now is to reduce my gearing, not by paying off any debt, but letting my portfolio grow, keeping my debt the same. So ideally, as it grows by 10% with the natural market, ideally my gearing comes down about 8 or 10% as well. So that's really my goal, and to build up my buffer. So I just want to secure for life what I've achieved rather than trying to keep pushing the limits. But I still believe that property is going to rise. And so if I was at a different point of my cycle, yes, I would be buying now.
And this is important. You talk about investing cycles and on the Smart Property Investment Show. And back in the day when you're on Sky TV doing what you're doing, and I think me and you sort of appeared at the same time on those shows, which are sort of long beyond us now. Most of them were around the acquisition phase of property investing. What should you buy? Where should you buy it? And when you should buy it? But there's a whole other part of this sort of property investment equation, and that is, okay, how much do you actually need to buy when you've bought enough? And then what do you do with it? And sort of that's clearly at the point you're at right now. Do you think in time you'll sell off any of this to be completely debt-free? Is that the game?
Look, the accountants have talked about it. So obviously I've got good advisors that I discuss these things. And the reason I'm very public with my numbers is I like the debate. So I like cleverer people than me challenging what I'm doing to say, well, a good question, like, should you sell some? And the accountants have certainly talked about that to reduce the debt down to then be reasonably debt-free. But at the same time, is when the market's moving at 10 or 20%, would you really sell $1 million property now that's rising at 100 or 200 grand a year just to pay off some of that debt? So I don't think I will. But what I've also found is when you buy your first 1 or 2 properties, property investing is 100% property investing. Once you've got a bunch of properties, property investing is 5% of it. 95% of it is getting money from the bank. And so if suddenly I'm then kind of asset rich and cash poor and I can't extract any more money out from refinancing because you need a higher and higher income these days, then potentially I would look at selling just then to release cash.
But you're not in the rush, right? To your point, you're better off holding on to it now while it's rising so rapidly. And at a point in time, that will stop and peter out. And whether or not there will be a correction to the market, who knows? We could probably have a chat about that. We'll go to a quick break. When we come back, more into Chris' portfolio. Back in a moment.
In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Chris Gray. Chris, give me a sense for your portfolio. So you said it's about, $20 million valuation these days. You're running about 50% LVR, so that's a loan to value ratio. It means that you got $10 million worth of equity. How many properties in the portfolio, Chris?
So I always forget, but I think it's about 13 or 14.
Okay.
Mainly in the eastern suburbs in Sydney, and a couple of my original ones from, I think, 22 and 24 back in the UK. So most of the properties are roughly 1.5 million. They range from one bedders that are maybe 50 square meters to three bedders, some that are right on the ocean and some that are a bit further back. Generally yielding probably about 2.75% yield now, because obviously they were getting about 3.5% before, but obviously as you get 10 or 20% growth in the market, then your yield comes down. But obviously the mortgage rates I'm probably paying about 3% at the moment, which is obviously more than most people because I've got a high amount of debt, so it's more expensive. So I'm probably negative geared, maybe about 50, maybe 100 grand a year, depending on what I'm doing with the properties. So
you're happy that's just the cost of doing business, right?
Yeah. So I always talk about the break-even point. So how much does property have to rise by for me to break even? Well, if it rises by 1%, it goes up 200 grand on 20 million. So as long as I get 1/4 to 0.5% growth, I'm making money. So as long as I can cash flow it over the next 5 or 10 years, I think I'm going to get more than 0.5 or 1% growth.
And the lenders are happy with that particular philosophy or approach you take?
Yeah, look, if you just walk into the bank and say, I want to live off equity and this is what I'm doing, then they're not allowed to accept it with current laws. But a lot of the bankers I use, they understand what I'm doing. They know I've been in the game. And look, they realize there's a difference between someone that's studied and been in real estate for 20 or 30 years and is a commentator versus your typical mum or dad that might have a 300 or 400 grand property. So they do give me a bit of kind of freedom there. But at the same time, when your debt's 10 or 11 million, it's pretty scary for a bank. So you think it's easier and easier to get a loan when you owe more money, but after a while, it actually gets more difficult.
Because it's the beauty of Australian real estate. Most lenders, look, you might have an argument around the valuation of a property, but lenders, banks in particular in Australia, they like Australian real estate. You only need to think back to the GFC or this most recent crisis. It's where most of us, most Australians, if you've got a super fund, whether it's self-managed or a retail fund or industry fund, guess what? A lot of it will be with the major banks. The reason why is the major banks are strong. Why the major banks are strong? Because they love lending money, even though you think they might not. They do. That's the business they're in. And that pretty much buoys up their balance sheets and their ability to generate profit. So it is at the heartbeat of the nation, property, because it sustains our biggest businesses, which employs a whole bunch of different people, and it's where most of us have our wealth. So if you can present a good proposition to a bank, even if you're borrowing 10 million bucks, they'll give it to you.
Yeah, but also it depends on the quality of the property as well. And if you've done what you promised you're going to do before. So if you've always made your repayments, you say you're not going to go and blow all this equity on expensive toys and stuff like that. I've got some
like
toys.
Unicycles and Model T Fords.
Yeah, they're not too expensive these days. And as you can see, like I'm a well-known rent investor, so I'm in Darling Point. Obviously, you can see the view behind me if we're on anyone's on video. But effectively, because of all the assets I've got, 1.5 million, that's effectively the median price, the average price in Bondis and Coogis and Tamaramas. That's really safe real estate from the bank's perspective, because it doesn't suddenly half in value. And I haven't got my family $5 or $10 million home because I rent for a living. So from a bank's perspective, I'm fairly low risk. And again, I've got the right advisors to advise me to make sure I know what I'm doing.
So let's just have a look at this portfolio. So you said most of it, or all of it, it sounds, except for the stuff you got in the UK, is in the eastern suburbs. That's a pretty sort of condensed place to put all of your assets versus other people that always talk about diversifying in different asset classes in different areas in different states at different times. Are you comfortable having all your eggs in that eastern suburbs basket?
As long as we don't get a tsunami. So, look, there's arguments for specialization, which is obviously what I've done, and there's arguments for diversification. So, look, as a business, we typically buy eastern suburbs, London or Shore in the west, so avoid the CBD where there's no height limits, and that's our main area. And so normally I would be happy investing in Manly or Neutral Bay or Balmain or all those areas as well. But my rule for myself is what the same is for my clients, is I say, look, I look at all of those 15 suburbs, but I buy when something comes up, when I can get it on valuation, which guarantees I'm buying the right price, on building inspection and strata inspection. And it just so happened a whole bunch of them actually came up in Coogee. So I think I've got 10 in Coogee of the 12 in the eastern suburbs. And so ideally I wouldn't plan it that way, but I believe in karma, fate, and all the rest of it, that sure, it could be more diversified, but look, generally those blue chip suburbs, they all perform well. And look, some of them I bought whole blocks and then managed to add extra levels on or do other things. So it's worked out well.
How much time do you spend a day doing your own property stuff versus your day job?
Oh, look, it would be half an hour a month at the most.
Yeah.
So basically the routine is, obviously I get my rental statements on the last day of the month and I put it all into Excel. So I run everything on Excel. And I do it to not only record what's going in, but also to make sure that the property managers actually put the money in my bank account. And then I know my mortgages come out on the 18th. So on the 18th, I go in, or the 17th, I go in, I make sure there's enough money in the account to pay the mortgages. And then I obviously see the mortgage come out on the 18th. So look, that would probably literally take me 10 minutes each time. And then I've got another 10 minutes basically for the odd email from a property manager. But most of the time I say, look, anything under $1,000, just go and fix it. And I'm very much a delegator and I don't believe in managing people kind of super tight. And so we've got a great relationship. They get on with stuff. If they give me recommendations, I follow their recommendations, which means I've got more time to hang out and then have fun rather than micromanaging it, which doesn't really make any difference.
So have you been able to set all your mortgages come out on the same day for all your different properties?
Oh, because a lot of them are with the same bank.
Oh, okay. Yeah.
So look, a couple do come out, I think, on the 3rd of the month. And I've got one with another bank that is the 31st, but the majority all come out on the same day.
Yeah, that's good. You know, managing my portfolio is a headache. They come in at different times. And I don't know, I just go, hopefully there's enough money there, it'll be right. Cover it off.
So when your debt's 10 or 11 million, then I can't leave it to chance.
Yeah.
And so being an accountant by trade, I'm just super organized, but that organization means that I'm time efficient. So I just have recurring things in my diary is 7 a.m, check there's money in the bank for the mortgage. Next day, check the mortgage payments have gone out. So if the odd time, then I've got the money in the wrong account and I'm overdrawn $10, which could cause you chaos later on with refinancing, I fix it within 24 hours, so it shouldn't come up on my credit data. And again, I get the, is it Visa Advantage these days where you get your credit alerts as soon as someone touches something?
Yeah.
So all of those things, that's what you need to spend time on to make sure that you secured your position for the future.
Yeah, and that goes to the point also around a lot of people get obsessed with the acquisition of property, but when you're good, effective management of your property portfolio, what you're talking about there, that's not the sexy stuff, it's the boring stuff, but it's the critical stuff if you want to be able to not only retain or sustain a portfolio, but grow it over time and realize the value of it. So for you then, Chris, moving forward, you put the brakes on, no more buying, maybe some refinancing, you're busy in your day job, your empire. What's going on with it? Because I know we've spoken about it in the past, and I think we've even debated, the way in which your recommendations of how your clients should be buying property and where. Is it largely the same as it always has been? You still recommending this blue chip
Nothing's
stuff?
changed in 30 years. So I'm not busy in my day job. So my routine now is basically I do emails and article writing and stuff like that between 7 and 9 in the morning. And then I've now got in the routine. I bought myself a Bondi residence parking down at the beach. And the idea now is to be out and about. So I can do these. So thinking it's video, I've actually gone home. I've had a shower and a shave and I've got ready for the video, even though I think we might be audio.
We're audio.
Normally, I might just hang down at the beach in my van and then just do it from there. And I'm just running around in my cars, just having fun, doing bits and pieces. If I need to do an open home, I'll do the odd one here and there or meet a client or get on a call. But I can basically run my day from anywhere now. So I really want to get in the routine of having 2 hours a day of solid work and then the rest just fit in around other stuff as it happens.
Yeah.
So I've got a team around me. So I've got someone that looks after all the clients. We've got someone that looks after all our referral partners. We've got one guy that does all the buying. Everyone knows their job. We've got a process for doing it. We've done it hundreds, if not thousands of times. We're all adults. So we get on and do our job. We all earn good money and the clients get looked after and they get great properties at valuation prices. So it's a simple system, but they always say, keep it simple.
Yeah, keep it simple, keep it simple, stupid, right?
Yeah.
That's what it is. But look, we'll get another break, Chris. When we come back, let's chat the market back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. Phil Tarrant from Smart Property Investment with Chris Ray, Your Empire, chatting through his portfolio. I want to sort of transition into the market right now. It's mad over in the eastern suburbs, mad in Sydney, it's mad all over Australia. Very little stock on market. I think everyone's sitting around waiting for the starter pistol to go to actually start listing properties for sale. I'm in the market myself right now. I can't find anything that looks good at the right value. Many of the propositions for a buyer's agent, Chris, is to find the properties that you normally can't find, or find them under market value, or find them and negotiate them more effectively. Is that largely commoditized now? How do you get an advantage as a buyer's agent when there's very little stock out there?
Well, you should have a chat with my team then, Phil, if you can't find something. So I don't want to say we love this COVID time, because obviously no one loves COVID, and there's some bad things happening in the world. But for our business, it's actually going pretty well, because we've always gone for areas which have got no stock. So whether it's GFC, it's boom, it's COVID, it's whatever, there's no stock in those suburbs. If you're trying to find two-bedders with parking close to the beach in a small block with low strata fees for a valuation price. Because obviously at the moment is, why would you sell for $1 million when you can take it to auction and sell it for 1.1 or 1.2? So what we're liking about the COVID situation is that tenants don't want people coming through their properties for open inspections, nor do vendors, but some people still want to sell. And as Tom Panos, who I know is a guest on your show, he says, like, sell in isolation, not in saturation. So now's the time to sell your property when there's none others on the market, versus in the middle of summer when there's stacks. So if a sales agent has only got one or two appointments, private appointments to get someone in, would they let Joe Public in, who is probably tire kicking, hasn't got pre-approved, is probably wasting his time? Or does he let a buyer's agent in that he's dealt with for 20 years? They've bought 100 properties from him. They've got pre-approved customers that are prepaid in advance, that are highly motivated to buy it, that quite often the clients don't even see the properties because they're investment properties anyway, that we can almost guarantee 99% that we'd buy the property before we even walk in the door, because the chances are we bought in that building anyway. And so vendors aren't taking it to auction now, which is perfect for our model, because we're trying to buy on valuation. And so we're saying, here's a guaranteed $1 million. No one knows what's happening tomorrow. You can't even go to auction. Take the $1 million, we'll write you a check, the deal's done, and you can forget about having COVID-infested public coming into your home.
So what do you mean by valuation price?
So obviously, when you go and buy a property, you get a valuation from the bank, and the banks are super conservative. So we go and use bank valuers, but not necessarily from your bank. We want, when you get your bank valuation done, they'll do a 2-page report that probably costs you $200, maybe even $100, or maybe they even do a desktop. We pay $660 so that the valuer is spending 2 or 3 hours physically going in that property and comparing it to other ones, and putting a 30-page report with 6 or 12 comparables to really know what that property is worth.
And then you'll just go to the vendor or the agent representative saying, hey, we've done this report, this is what it's worth. Does you want to sell it at this rate?
So sometimes we could use that valuation to go and knock them down, to say, look, our client, sure, you might think it's worth 1.1, maybe it is, but our client can only pay what the bank will lend them. Here's the valuation, it's only $1 million. We can write a check for that straight away, or you can take the gamble of going to auction and having people through your house and the disruption and whatever. And if that vendor's already found their dream home and they just need that $1 million to then secure their dream home, it's a bird in the hand. They'll take that $1 million.
Yeah, and that there in sort of the power of the buyer's agent, which, I've for many years been highly supportive of the way that buyer's agents do. There is the advantage there. And for those investors not using them, well, you need to understand there are. So you're operating with that within that competitive environment. And this market is very competitive. Now, let's get out of the bubble that is the eastern suburbs. I don't really like going over there personally. I don't like Bondi Beach. I'm more of
a North Shore man.
I'm a North Shore man.
We buy in Manly as well, and Fairlight and Queensland.
Well, yeah, I do like Manly. Manly is my go-to place, but I just live in North Sydney way. But tell me about the market. Where would you be buying right now? And we can't go really outside of Sydney, so I'm happy to sit in Sydney because this is where you do most of your buying. I've got $1.5 million to spend as an investor. Where do I put it right now for the purpose of capital growth, Chris?
So look, my advice has never changed. And I came to Australia in 97. I bought my first in 99 and we've never changed. So effectively we go Maroubra to Bondi and then say Rose Bay, Double Bay. In the North Shore, we go Neutral Bay, Kirribilli, Cremorne, Manly, Queenscliff, Fairlight. So basically walk to the Manly Ferry. And then the inner west, like the Balmains, Leichhardt, Annandale, Marrickville type thing. So for $1.5 million for a 2-bedder, you can get into the best suburbs. So you can get Neutral Bay, Kirribilli, Cremorne, you can get Manly, you can get Coogee, you can get Bondi, Tamarama, Balmain. You've got a choice. So really for the 2-bedders, we're looking at about 1.25 to 1.75 now. And that is the median price of property in those areas. It'll rent every day of the week, block of 12, double bedrooms, parking, balcony. That's the boxes to tick. But the problem is there's none of them. And when they come on, there's 1 million people that want them. And that's why they'll generally sell 5, 10, 20% above valuation at auction. And so hence, that's why we need to get it before auction. We've got to have the relationship with the agent. If you haven't got that relationship, you'll be paying the auction price.
So how good are your relationships with the agents? Can you call them up and go, okay, we're in the market as soon as you find something, or you're asking them to door knock for you?
We've been asking them for 20 years.
Yeah.
So the same agents sell the same properties. They know who the buyers are. So a lot of the agents know that if it ticks the boxes, they can ring us up. They know we've got a queue of clients, so we can write a check straight away. Whereas if the vendor wants to go to auction, and we ring up and say, oh, what about this property? They say, don't waste your time. Want to go to auction? And we'll just say we won't bother.
How much stuff is actually getting sold before market? Now, this is every vendor has a different sort of circumstance, and no doubt the good agents will know exactly what the drivers are. Are the agents right now in those areas you spoke about sort of going, hey, we can sell it off market. We don't need to list it. You're going to save a crap load of money on marketing fees and all this sort of stuff. We've got buyers, let's do it off market. And this whole discussion about what is off market, what is off platform, what is pre-market. I don't really want to go into that, but if it's already with an agent, it's sort of on the market, true off market stuff, you got to try and get out, probably riding your unicycle around or your car, mate. And someone goes, oh, hey, I've got a place I want to sell. But how much stuff is actually getting sold before it even hits your realestate.com.au?
So that's the thing. I mean, ultimately, you'd never really know because it obviously doesn't appear. The only way it appears is if the agent then puts a signboard on it, or they suddenly put the advertising on afterwards just to promote, to get all the PR off the back of it.
Yeah.
But look, 99% of the properties we buy are pre-auction. Probably 75% are probably true off markets, which means, sure, the agent signed it up, but it hasn't gone on to realestate.com and it hasn't been open to the public. And sometimes we actually want it going on the market because let's just say for that $1 million property, the vendor wants 1.1. We might go in there, we might get our valuation, building and strata done, but the vendor is still reading the newspapers saying everything's going through the roof. So sometimes we want the agent to put it on the market for the first Saturday. And so the agent can say, look, we had 20 people through. It is a really fantastic property, but no one's offered that 1.1. No one's talking that number. These guys are here. They've got a check for $1 million. They don't go to auction. You've got a choice. You either take it now, you might get more later on, or take the bird in the hand. And it's amazing, as you said, is about saving the money, because our advice to clients when they want to sell, and we only probably get one client a year selling, our advice is don't sell. The second thing is if you do want to sell, give it to the best agent, do the best marketing campaign, style the property, get rid of the tenants. And that's your best chance of getting record for the street or for the building. Or the third one is we'll buy it off you for valuation price, which is neither high nor low. And obviously one of our clients will buy it. And it's amazing. A lot of people will actually still get us to buy it at valuation because they say, hey, look, I bought it for $500,000. It's worth $1 million. I've made $500,000. I've done absolutely nothing. No grief. Just write me the check. Even though they could get another 50 or 100, it's like trading in a car. The amount of people that just want the cash without the hassle, they'll just go and do it.
So how much further is this market going to go in Sydney, Chris, in the areas that you're operating with? I know the banks are sort of talking about another 20%, this year. Like, happy day. I'm going to go and reprice my portfolio now and might even treat myself a fancy lunch, feeling wealthier. But how much more is this going to run and when's it going to stop and then reverse?
And look, I'm not an economist, but from what I've learned in the last 30 years, I think it's got a fair way, because the market was starting to, so in 18-19, we had the credit crunch and the banking commission. And then at the start of 2020 in February, the market was just about to take off. is the next cycle. COVID hit in March, and so that collapsed it. So there's all this pent-up demand. The market then retook off in February 21. We're now in August or September now. We're only 7 or 8 months into the new cycle. A cycle is normally anywhere from kind of 2 to 5 years. And so many people were saying, like, we were telling people on the Sky News and the property shows, 18, 19, now's the perfect time. No one's buying. That is the best time to buy. Contrarian is 101. Buy when no one else is buying, but no one listens. They all follow the sheep and they all jump in February. And then by May or June, they all think they've missed the market and they're going to wait for the next cycle. They're going to wait for the drop. And you would have seen it. Being in the media, we see it every single cycle. And so, look, I don't know if it's going to carry on for 1, 2, 3, 4 years, but I reckon the chances are it will. And I even found in the GFC, the market was still rising 2, 3, 4%, but it just wasn't recorded in the media.
Yeah. So, well, the media, and I guess we sort of bundle ourselves up, and we're the good media. Particularly me, Smart Property Investment Show. I don't know about you, Chris, but mate, you only need to think back to the start of the COVID pandemic when some of the banks are coming out sort of saying there's going to be 20 to 30% drop in property prices. I'll tell you what, most of the media jumped on that. The doomsday merchants, and the good thing about doing this podcast is essentially I get to diarise weekly what's going on in property in Australia. And I reckon I can go back to listen to myself at that point in time and I'll be going, yeah, don't worry about that. It's all okay. Property's still a good asset class. You should be using this time to do A, B, C, D, E, F, G. So be careful who you listen to in the media, but give me some sense for it. Should Australians and Australian investors still be doubling down on property, or should they be looking elsewhere? I hear antique vehicles are a pretty good investment. You can buy for 30, get it insured at 50 and probably resell it, rebuilt at 100, mate.
Well, look, the car thing I'm actually getting into because in the week of COVID, I bought a Murcielago, a Lamborghini 2005 for 250 grand 7 or 8 years ago. I sold it in the week of COVID. This is March 2020 for, I think, 290. So I had it for 7 years, drove 50,000 Ks and it went up 40,000. So it's a free Lamborghini. Now I'm building another couple of cars, a Buick and a 32 Ford Tudor. So I'm getting into that. But as much as it might make a tiny bit of money, I believe in the property.
Yeah.
And look, probably in all the interviews I did for 10 years on Sky News, the best one, the one I most liked was a guy, you'd remember, John Edwards from Residex.
Yep.
And he was like the king of predicting capital growth. He was a genius, like an actuary, very, very clever man. And we always used to have the discussions about how can property prices keep rising? If wages aren't keeping up with inflation, how can properties keep rising? And his answer was, look, our parents used to have massive blocks. Now we have small. They used to have one income. Now we have two. Their interest rates were 15, 20%. Ours are only 3 or 4 or 5 or whatever. But he said that's part of the reason. But the main reason in the blue chip areas is if there's no more supply of property and there's wealthy people that want to buy it, supply and demand overrules every other economic law. And so I use Bondi just because everyone knows Bondi. There's no more physical units in Bondi. Even if you knock down a few houses and build a few more, you're not going to increase the supply more than a couple of dozen every year. We've got clients at the moment that are buying their daughters $2 and $2.5 million homes for an 18 and 19-year-old, which is mad. Yeah. But there's enough of these wealthy people, or they're giving their kids 100 or 200 grand deposit to buy $1 million Bondi unit, or Coogee or Manly or Balmain or wherever else. So I'm not saying I necessarily agree that that's wrong or right, but I'm saying that's what happens. And so we're not buying $50 million in Point Piper. We're buying medium price for Sydney. Now, I know $1.5 million if you're in Adelaide or somewhere else in the country or regional, that's a lot of money. But locally, we all know it's not. And so if there's no more supply, Bondi is beautiful this morning. People will pay 2 million, 3 million, 4 million, and they're even paying 20 or 30 million to live there. I think that will continue.
Yeah, and you can sit around and complain about not being able to buy where you want to buy, or how other people have advantages, i.e. their parents buying them a property or giving them the cash to get in there. But you know what? That's the reality of the world. So as a property investor, if you can't operate in those markets, you've got to find markets that you can operate within. And I think that's the key point, Chris.
Yeah, it is. And so we've done lots of newsletters, and we've bought some regional stuff like in Newcastle and things like that, is to say, if you're 20 years old, you can't expect to buy a penthouse in Bondi. or in Manly or wherever your dream suburb is. You've got to start off slowly. So whether you can buy a shack for 100 grand in the middle of nowhere, sure, it's not the ideal situation, but at least you're on the ladder. And the main thing is with property is, as a first home buyer, you're not putting down 100 grand. You're putting down maybe 5% deposit, maybe 5% stamp duties and stuff. And so it's the leverage and the compounding that makes real wealth, whether you're buying for 100 grand or $1 million. So you basically need to get on the ladder. And location is there for a reason. The best possible location you can buy and you should buy in, even if it's a little shack, use that, let it grow, pull the equity and keep repeating. And that's what all of the property investors do. 95% of what we all do is all the same. We might have different views on positive cash flow or capital gain or doing a reno or new or secondhand, but 95% of the rest of it, we all completely agree on it.
Yeah, well, that is, we want capital growth. That's what most investors want.
Yeah.
And to you, that's your strategy, right? You live all the capital growth in your portfolio, and that's been a key driver for you.
Yeah. Look, I mean, in my business, I can earn a few $100,000, maybe $500,000, $1 million if I try really hard. But suddenly in this market, I'm making, say, 2 or 4 million. Sure, that's not all year, every year, but that is the benefit. Even if I get 2% growth a year, it's still 300 or 400 grand for doing nothing. So you all start on one property. I started off on one property like everyone else, and it just builds from there. And I never believed I'd have this much.
You still got your UK stuff?
Yeah.
Where is it?
That's in a place called St Albans, which is about 20 miles north of London.
Yep.
So again, it's a town which is all heritage, so you can't build any more physical property. So it's got a lack of supply. There's lots of wealthy young professionals that commute up to London that earn the big money and have wealthier parents. So they've got the supply and the demand kind of thing there. I borrowed, when I was 21, 22, I borrowed 7 times my income instead of 3. So I got a parental guarantee. My mortgage was more than my wages before tax, but I bought a 3-bedroom house instead of a 1-bedroom unit, rented 2 rooms out, and the rent from the 2 rooms paid the whole of the mortgage. So it's just thinking differently to say, my goal is to get to here. How do I do it? If 10 people say no, okay, how? There's always a way.
Well, let's leave it there, Chris. I think that's a good bit of counsel there for our young listeners. Sitting around and waiting for perfect environments and conditions to start investing in property is never going to arise. You need to detach from maybe where you want to live to where you can actually afford to buy and just get started, because only then do you get options for growth in time. Let's not leave us so long between chats, Chris, next time. And mate, I never get down to Bondi. I'm more of a sort of Manly guy if I go to the beach, whether it's for a surf or a swim. So I'm not going to see you riding your unicycle, mate, but make sure you get someone to video you. And I see this sort of beer getting drunk riding your unicycle.
Believe me, when it's going to be, I'm about 5 weeks into it, so it's going to take me about 8 weeks. If I've pushed that hard to get 8 weeks, believe me, I'll be sending it out everywhere.
All right. Well, even if we're allowed down there, mate, by that period of time, I come down for an appearance to watch all this happen. And don't worry, ambulance will be standing by.
Exactly. That's why I do it by the Bondi lifeguards.
Nice one, Chris. Great to chat, mate. Really enjoyed that. That's Chris Gray, Your Empire. If you've been in property for a little while, you're probably no doubt familiar with Chris from Sky TV. Now everything is shifted to the marvels, that is the interweb and podcasting and other stuff. So that's where property investors get their information, including the Smart Property Investors Show. You're part of a very large community of people who tune into this, and I often got to pinch myself to think how many people listen to me drone on most weeks talking about property, but there's a lot of them, which is good. All I want is better informed property investors so they're making better informed decisions. smartpropertyinvestment.com.au, social media, Smart Property HQ is where you can find us. One quick favor, I'm sure Chris is going to do this straight after this. He's going to leave a review on whatever podcast platform he listens to, probably iTunes. It's just not myself here. There's a big team that make me sound good and do all the heavy lifting with this particular show. They get a kick out of that feedback. So if you can leave us a review, that'd be great. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.